We have seen that huge market rally, not only here in the U.S., where we extended those gains, as this chart shows our viewers, with the S&P 500 further into bull market territory, the NASDAQ 100 gaining more than 30% from its 2022 lows, even EM stocks almost at that bull market territory. So is this frothiness what we're seeing right now, especially if we have also concerns about global liquidity?
Yeah, I mean, obviously there's a macro question and there's a market question, right? So if we look at the macro question first, we still think we're sliding towards a recession. Obviously, trying to time that is going to be very difficult. But, all the indicators, all the recession checklist indicators that we look at are moving more and more towards signaling a recession is coming. So that is obviously at some point going to kick in to be a headwind for equity markets. In the short term, though, we still have very severe positioning, which is very short or underweight global equities. And you alluded to the inflation numbers, obviously, this week are going to be really important. And there is a good case to be made that inflation will come in lower in the coming months, which may temporarily give this soft landing scenario more countenance in the markets. We ultimately think that's going to be disappointed, but that could still lead to the continued melt-up in equities in the short term.
Yeah, some are saying that if we do see a mild downturn, a soft landing, that we could see another rally in cyclicals. And given, of course, that we already saw moves from China to, boost their economy, could that all add up to some gains in sectors that have been really under pressure lately?
Yeah, absolutely, it could. I think the narrative is probably going to be one that we do see people becoming less concerned about a sharp recession. Ultimately, I think they'll be disappointed because the size of the tightening and the long lags that we have in terms of that hitting the economy. I think we will see a slightly stronger than expected recession, so a harsher recession than the normal. Nothing GFC-like, of course, but something that would be pretty damaging to sentiment. But as I say, the challenge is, when do you time that? Do you time that for the coming quarter, or do you say it's going to be towards the end of this year, beginning of next year? And that's obviously the hardest question to answer, in our opinion.
Steve, how are you gauging market expectations when it comes to what we get from the PBOC and other Chinese authorities? Are we sort of almost inevitably setting up for disappointment because we know that it is not going to be, a massive move from the central bank there?
Yeah, I think obviously the key thing that's happened this year, two key things, is we've seen real GDP growth accelerate quite strongly, of course. I mean, obviously there's some narrative around the disappointment in terms of how strong that has proven, but the reality is it has been pretty strong. But we've seen at the same time inflation come sharply lower, PPI obviously in negative territory, and CPI around zero. So nominal GDP growth hasn't really done a lot. It's accelerated marginally. So I think the authorities are still in an easing policy environment, but clearly they still don't want to repeat anything on the scale of what happened in 2008. So it's softly. And that's going to support growth, in our opinion. But given the global headwinds, the question is, when do we see peak growth? Do we see it in the first half of this year, or do we see a resurgence in the second half? We're starting to see consumer confidence in China bouncing off very depressed levels, of course, but it is starting to bounce. So that suggests that maybe second half will be okay. But I think, coming to the beginning of next year, we could see a deceleration. So policy easing, yes, but still gradual from our perspective.